63 cents. That's what $1 buys you in US currency right now. 18 months ago it was 68 cents. And here's the thing most people get completely wrong. They think that drop is bad for investing. It's not. It's actually the opposite. The average Australian putting $300 per month into a US index fund when the dollar was at 68 cents ended up with $4,200 after 12 months. Exactly the same $300 per month invested right now at 63 cents. You're looking at $4,700 over the same time frame. Same income, same time frame. You've got $500 more in your pocket because the currency moved the way it did. That's not luck. That's how international investing actually works. And right now, with the Federal Reserve nowhere near done cutting interest rates and the Australian dollar getting smashed by Trump's tariff talk, you're sitting in one of the better windows to start. Here's what's happening. The RBA's stuck. They can't cut because inflation is sticky. The Fed's still got room to move down. When one central bank is cutting and yours isn't, money flows out of Australia. The Aussie dollar weakens. And when your dollar is weak, your money goes further when you're buying US assets. You get more US shares for your $300, not fewer. That matters a lot. Most beginner investors freeze when they see the Aussie slide. They think the dollar will bounce back soon. They wait. They don't invest. And then 18 months later, the dollar's still at 63 cents, and they've missed 12 months of US market gains because they were betting on currency, not companies. You know what most people do when they see volatility? Nothing, and their bank is absolutely counting on that. Here's the exact math. If you invest $300 per month into a US 500 index fund at today's rate, you're buying roughly 471 shares per month at current prices. That $300 monthly for 2 years at 7% annual return gets you $7,680 principal plus $560 in gains. Simple math, but that's if the dollar stays flat. If the Aussie weakens another 5 cents, down to 58 cents, that same $300 is now buying you 517 shares instead of 471. That's an extra 46 shares per month. Over 24 months, that's 104 extra shares you own. At $150 per share, that's $165,600 in extra holdings, and you did the exact same $300 per month contribution. The currency move did the heavy lifting. Here's the other play. The Fed's not done. Markets are pricing in another 75 basis points of cuts this year. When that happens, US share valuations typically expand. You get 2 tailwinds at once. The currency gets cheaper, and the shares you're buying get more expensive. That's actually insane when you see what it means for a 2-year horizon. But here's where most people trip up. The second you wait for confirmation, the move's already halfway done. You think you'll invest once the dollar stabilizes. It doesn't. It trends. And trends move fast when capital is flowing out of a currency. The play right now is this. Open a brokerage account if you don't have one. Vanguard Australia, Superhero, or Sim let you buy US index funds directly. Pick a monthly amount you can stick with, $300, $500, whatever works. Set it to automatic. Then don't look at the exchange rate. Seriously. Stop checking it. What changes everything is the Fed's move. If the Fed cuts rates sooner than expected, money stops flowing out of Australia so hard. The dollar bounces. But here's the thing. If the Fed cuts and the US market rallies, you've still won. You own more shares at a higher price than you would have otherwise. Currency doesn't matter as much when equity returns are north of 8%. And if the Fed doesn't cut, the dollar keeps sliding. You keep buying more shares with each $300 monthly because your money is worth more in US currency. Either way, you're ahead of the person waiting on the sidelines. This is honestly one of the better setups available to anyone under 35 in Australia right now. The next trigger is the Fed's next decision. That's when the market reprices. If you're still sitting on Australian dollars waiting for a better entry, you're actually sitting on a depreciating asset. The Aussie isn't coming back to 70 cents this year, not with the rate differential as wide as it is. So here's your move. This week, open the account if you haven't already. Next week, make your first deposit and set up the monthly transfer. By the time the Fed's next decision lands, you're already holding US exposure. By the time the Aussie dollar bounces, if it does, you're already in, you're already earning the market return, and you've already captured that currency benefit. 90 days from now, if you start $300 per month today at 63 cents, you'll have roughly $900 principal invested and about $50 in gains, assuming a 7% market return. But you'll own 414 shares. If the dollar goes to 61 cents in those 90 days, that same $900 would only buy you 310 shares at today's prices. That's the difference. That's why timing this right matters. The currency isn't your problem. It's your advantage. Use it.